Most people think that once you reach 65, every bill automatically gets cheaper or disappears. Reality is much more specific. There are legitimate federal and state programs that can reduce certain taxes, Medicare costs, prescription costs, utilities, and property tax burdens, but they are not universal exemptions, and eligibility matters. If you're 65 or older, living on Social Security, a pension, retirement savings, or some combination of the three, this distinction could matter to your monthly budget. You may not be legally exempt from 5 ordinary bills just because you're a senior, but you may qualify for programs that can lower some of those expenses, and one of the biggest opportunities is brand new enough that many people may not yet realize it exists. For tax years 2025 through 2028, the IRS says taxpayers age 65 and older may qualify for an additional $6,000 federal deduction per person, on top of the existing senior standard deduction rules. A married couple in which both spouses qualify could potentially receive a $12,000 deduction. The deduction phases out above $75,000 of modified adjusted gross income for single filers and $150,000 for joint filers. That doesn't mean the government is handing every senior $6,000 in cash. It's a deduction, not a $6,000 refund, but understanding that difference and knowing which programs actually apply to you can make a meaningful difference in retirement. So let's walk through 5 areas where seniors should stop assuming the bill is simply unavoidable and start asking a better question. Is there a program, deduction, or assistance option that I qualify for? The first one is taxes. This is probably the most important change to understand in 2026 because the IRS has specifically highlighted the new enhanced deduction for seniors. For tax years 2025 through 2028, an eligible taxpayer who is 65 or older can claim an additional deduction of up to $6,000. If both spouses qualify on a joint return, the maximum can be $12,000. The IRS says the deduction is available whether you take the standard deduction or itemize, subject to the income phase-out. Now imagine a single retiree who is 67 and has $55,000 of modified adjusted gross income. They may be within the income range where the full additional deduction is potentially available. But here's where people get confused. A $6,000 deduction does not mean the IRS sends you a $6,000 check. If your marginal federal tax rate were 12%, for example, a $6,000 deduction could reduce federal taxable income enough to save roughly $720 in federal income tax, assuming the deduction is fully usable and other circumstances remain the same. At a 22% marginal rate, the theoretical tax reduction could be around $1,320. Your actual result can be different because taxes depend on your complete return. That's why the right question isn't, do seniors get $6,000? The right question is, am I eligible for the $6,000 deduction? And how does it change my actual tax bill? The IRS also says eligible married taxpayers generally must file jointly, and the qualifying individual needs a valid Social Security number. This is where many retirees can make a simple mistake. They hear about a new deduction but don't ask their preparer whether it applies to them, or they assume that because most of their income comes from Social Security, there is nothing worth reviewing. That assumption can be costly. And remember, this is a deduction for taxable income. It is not an automatic exemption from federal taxes. Social Security itself also has separate federal tax rules. Depending on your combined income, some Social Security benefits can be taxable. So, if you're retired, don't look at your Social Security statement alone. Look at your entire tax picture. Social Security, IRA withdrawals, 401k distributions, pensions, interest, dividends, capital gains, and any other taxable income. The second area is Medicare costs. And this one is especially important because saying seniors don't have to pay Medicare would be completely wrong. Medicare isn't automatically free simply because you're 65, but some lower-income beneficiaries may qualify for Medicare Savings Programs that help pay Medicare premiums and, depending on the program, deductibles, coinsurance, and copayments. For 2026, Medicare lists several programs, including QMB, SLMB, and QI. For example, the federal QMB monthly income limit is $1,350 for an individual and $1,824 for a married couple, with resource limits of $9,950 and $14,910 respectively. But Medicare also notes that some states have higher limits or different rules. This is where the phrase, "I probably don't qualify," can become dangerous. A retiree may hear one number from a friend in another state and assume the same rule applies to them. It doesn't necessarily. These programs are administered through the states, and eligibility can vary. So if your income is limited, don't simply assume Medicare costs are fixed. Ask your state Medicaid office or Medicare about Medicare Savings Programs. The third area is prescription drug costs. This is where Medicare Extra Help can become extremely valuable for qualifying beneficiaries. Medicare says that in 2026, people who qualify for extra help generally must fall below specified income and resource limits. For the standard national limits, Medicare lists $23,940 of annual income and $18,090 of resources for an individual, and $32,460 of income and $36,100 of resources for married couple. And look at what the program can do. For 2026, Medicare says qualifying beneficiaries can have a $0 plan premium and $0 deductible under Extra Help, with covered prescriptions generally costing no more than $5.10 for generics and $12.65 for brand-name drugs, subject to the program's rules. That is not a minor discount for someone taking multiple medications. Imagine a retiree taking 5 prescriptions every month. Even a reduction of $20, $30, or $50 per month can add up to hundreds of dollars over a year. And for someone with a tight retirement budget, that money can go toward groceries, utilities, transportation, or simply an emergency reserve. Here's the important part. Don't assume home ownership automatically means you can't qualify. Don't assume having a car automatically means you can't qualify. And don't assume that because you were above the limit last year, you will always be above it. Medicare says you can reapply if your income or resources change. That is an important retirement planning principle. Eligibility is a snapshot, not necessarily a lifetime label. Your financial circumstances can change. Your spouse may pass away. You may retire. Your investment income may fall. Your medical expenses may increase. Your retirement withdrawals may change. And when circumstances change, eligibility for certain programs may change too. The fourth area is utility assistance. This one requires more caution, because there is no universal federal rule saying seniors can simply stop paying their electric or gas bill. Instead, programs such as the Federal Low-Income Home Energy Assistance Program can help eligible households with energy costs, but eligibility and benefits depend on household circumstances and state administration. That distinction matters. You don't want to hear a headline saying, "Seniors are exempt from utility bills," and assume it applies to everyone. It doesn't. What you should do instead is ask your utility company and your state's energy assistance agency whether you qualify for a senior discount, low income rate, medical needs, assistance, payment, arrangement, or other available program. This is especially relevant if your household has higher electricity usage because of medical, equipment, or other health-related needs. The objective isn't to avoid a legitimate bill. It's to make sure you're not paying a rate or amount that a program could legally reduce. And there is another important reason to make this call. Utility companies don't always know your circumstances. A billing department sees an account. It may not automatically know that the person behind that account is 78 years old, living on social security, or dealing with a medically necessary increase in electricity usage. Sometimes you have to ask. The fifth area is property taxes, and this is where the word exempt needs the biggest warning label. There is no nationwide federal rule that makes seniors automatically exempt from property taxes. Property taxes are primarily determined at the state and local level, but many states and localities have programs that can reduce, defer, freeze, or otherwise modify property tax burdens for eligible older homeowners. Some programs depend on age, some depend on income, some depend on disability, some provide a homestead exemption, some defer taxes until the property is sold, and some limit the amount of property tax increases. So if you're 65, 70, or 80 and still paying a substantial property tax bill, don't assume there is nothing available, but don't assume you're automatically exempt either. The exact program depends on where you live. This is where most people get caught. They hear about a senior in another state who pays dramatically less property tax and assume the same thing must apply to them. That's not how property taxes work. Your state, county, city, and sometimes even your specific property classification can matter. So the question you want to ask your local assessor or tax office is very simple. What senior property tax relief programs are available, and do I qualify based on my age and income? And that's a much better question than, am I exempt because I'm over 65? Now let's bring these 5 areas together. Imagine a hypothetical 72-year-old retiree. They receive Social Security, they withdraw money from an IRA, they pay Medicare premiums, they take several prescriptions, they own their home, and their electricity bill has increased significantly. There isn't one magic rule that makes all 5 bills disappear, but there could be several different programs or tax provisions that affect different parts of the household budget. Maybe the senior deduction reduces federal taxable income. Maybe a Medicare Savings Program is available based on income and state rules. Maybe Extra Help reduces prescription costs. Maybe a utility assistance program is available. Maybe the state offers property tax relief. The power comes from looking at the entire financial picture instead of treating every bill as completely unavoidable. And this creates 2 very different retirement paths. The reactive household receives the bills, pays them, and moves on. The strategic household receives the same bills and asks one additional question. Is this the amount I actually have to pay? That question doesn't mean trying to avoid legitimate obligations. It means understanding the rules. And that distinction is incredibly important. Because financial security in retirement isn't always about earning dramatically more money. Sometimes it's about reducing unnecessary outflows. If you save $50 a month on prescriptions, that's $600 a year. If a tax deduction saves you $700, that's another meaningful amount. If a property tax program saves several $100s, that's additional breathing room. If utility assistance reduces another expense, your monthly margin gets stronger. None of those numbers is guaranteed. But that's the point. You shouldn't build your retirement around savings you haven't qualified for. You should investigate the programs first, then calculate the actual benefit. Now let's make this practical. This week, pull out your latest federal tax return. If you are 65 or older by the end of the relevant tax year, check whether the enhanced senior deduction was included. The IRS says the new deduction is claimed using Schedule 1A for applicable returns. Don't guess. Look. If you're unsure, ask your tax professional specifically about the enhanced senior deduction. Second, look at your Medicare expenses. Find out exactly how much you're paying for Part B, Part D, Medigap or Medicare Advantage, and prescriptions. Then check whether your income and resources might put you within the range for Medicare Savings Programs or Extra Help. Third, call your utility provider. Ask whether they have senior, low-income medical needs or hardship programs. Don't ask, can you lower my bill? Ask, what assistance programs am I eligible for? That question gets you much closer to the information you need. Fourth, contact your local property tax office. Ask specifically about senior exemptions, credits, deferrals, freezes, or income-based relief. And fifth, write down your total monthly retirement expenses. Not just the big bills, everything. Housing, utilities, Medicare and prescriptions, insurance, food, transportation, taxes, debt. Then compare that number against your reliable monthly income. That difference is your financial margin. And your financial margin is one of the most important numbers in retirement. Because if you have $800 left after essential expenses, an unexpected $300 bill is uncomfortable but manageable. If you have $100 left, that same $300 bill becomes a much bigger problem. This is why small savings matter. They're not just about getting a discount. They're about increasing your ability to absorb unexpected expenses. And that leads to the bigger lesson. There is no universal 5 bills seniors don't have to pay. Be skeptical whenever you hear a claim like that. But there are real programs, deductions, and assistance opportunities that can reduce certain expenses for qualifying seniors. The key word is qualifying. Age alone doesn't guarantee the benefit. Income may matter. Assets may matter. Where you live may matter. Filing status may matter. The specific program may matter. That's why the smartest retiree isn't the person who believes every headline. It's the person who checks the rule. If you're 65 or older, don't be embarrassed to ask. If you're 70, ask. If you're 80, ask. If you're living on Social Security, ask. And if you have a comfortable retirement but your expenses are rising, you can still review your options. The goal isn't to maximize every possible government benefit. The goal is to make sure you're not overlooking something you're legally entitled to receive. Your future self will care less about whether you saved $5 on one bill. Your future self will care about whether you had enough financial margin to handle the unexpected. That's what this is really about. Not fear, not loopholes, not avoiding responsibility. It's about understanding the financial system well enough to make informed decisions. And as retirement gets longer, that knowledge becomes more valuable. So before you pay your next tax bill, Medicare bill, prescription bill, utility bill, or property tax bill, pause for a moment and ask one question. Is there a legitimate program, deduction, credit, or assistance option that applies to me? You may discover the answer is no. That's perfectly fine. But if the answer is yes, knowing about it could improve your monthly cash flow for years. And that's money that can stay in your household instead of quietly leaving it. If you're a senior or you're helping an older parent manage retirement expenses, I'd love to know, which of these 5 areas cost your household the most right now? Taxes, Medicare, prescriptions, utilities, or property taxes? Leave your answer in the comments. And if you want calm, practical updates about Social Security, Medicare, taxes, retirement planning, and the financial changes affecting older Americans, subscribe to the channel. The rules can change, the numbers can change, but one principle doesn't. Don't assume you have to pay more simply because nobody told you to ask whether there was another option.